Thank you, Doctor, and I'm pleased we're joined by Senators Coates and Lee today, as well as Congressman Mulvaney. Thank you. Let me lead off with not a housekeeping question, but reading the testimony last night, obviously divergent opinions on impact on taxes, capital, and the corporate tax rate. There seems to be a consensus in the economic literature that the Cobb Douglas production function provides a rough proxy for the private business sector of the American economy. The consensus is based on the empirical observation that the factor income shares going to labor and capital tend to be relatively constant over time. Would you both agree that the Cobb Douglas model is widely accepted within the economic literature, Doctor?
Mr. Brady, my old friend and mentor Albert Ando, who was one of the inventors of the life cycle hypothesis, gave his first macro lecture at Penn on the Cobb Douglas production function, and the first sentence of that lecture is, "The Cobb Douglas is very dangerous." And so I think the Cobb Douglas is a very useful way to think about back-of-the-envelope big macro questions, but it also has some features that can lead you to conclude things that are unrealistic in some applications. And so I don't want to make a sweeping yes answer to that question.
Thank you. Dr. Gravel?
Well, I use the Cobb Douglas in my model, so I do what a lot of people do. I think there's some recent evidence that suggests that substitution elasticity might be a little lower, which would reduce the capital inflows, increase the share to labor, the relative share to labor. But I think it's a pretty reasonable estimate, and it is backed up by a long period of constant factor shares, which is some important evidence, I think.
Can I ask Dr. Gravel, in your testimony, you suggest that the revenue maximizing rate on corporate tax is closer to 80% than it is 30%.
Right. That's based.
Yeah, go ahead.
That's just from real capital flows, so it doesn't include any of these other profit shifting possibilities. But that's just the constraints.
But when you're looking at the revenue, just so I understand, are you only counting corporate tax revenue? Or you
that 85% number is only corporate tax. The numbers that I gave in my testimony count the effect on wages. But that's just from, there's constraints about how much capital can flow, both because of imperfect willingness to substitute, but also because of the natural limited ability of the economy to absorb a lot of capital because it has a fixed amount of labor. I mean, that's just economics.
What happens if you increase the corporate tax rate to 80%? What's the after-tax rate of return on corporate capital? Clearly, you've dramatically driven up that cost.
I presume if you drove the tax up to 80%, you would get some kind of worldwide equilibrium, but I would have to work on that to tell you how much that would be. But it would obviously be a lot smaller after-tax rate of return than we have now.
Do you know what happens when you do that? What happens to output? What happens to wages and the capital stock? If you raise
I would think there would be a 10 percentage point change is worth 2/10. So you could probably roughly multiply that, every 10 percentage points. So you would get up to 2-3%, I guess.
We'll probably follow up with you on that with written
I just can't quite do that in my head right now. So,
can I ask Dr. Hassett, before we move on the tax burden and the empirical data, which you cite repeatedly in your testimony, suggests that additional investments typically result in higher real wages. There's sort of in Congress, people forget about the impact on wages and workers. If taxes on capital affect the level of investment, shouldn't they also affect the level of real wages?
Yeah, they absolutely should. And, the effects, and this is discussed at length both in the recent CRS report and in my testimony, the effects that you see in the data are very large. You see capital flows in response to tax differentials, and then you see big increases in blue-collar wages. There have been a number of papers that have confirmed this finding. The CRS itself has taken our data, we've shared it with them, and replicated the results when they use our specification. They have their own favorite specification at CRS where the effects are smaller or insignificant in even one. But I think that the balance of the evidence is that there are pretty large wage effects. And I think that the wage effects that we see are a challenge to the traditional type of theories that Ms. Gravel and her colleagues use. I think that one of the reasons why we see these big effects is that multinationals have a lot of goodwill. They have patents. They have cool ideas that they can move around. They can locate the smartest people and the most valuable intellectual property in the most attractive tax haven, and then have every subsidiary around the world transfer price their profits to that tax haven. When that kind of activity happens, it's really elastic, and it's really good for that, for the market conditions in that tax haven. And so I think in the old kind of models that traditional tax people used, especially when I was in graduate school, which is a long time ago now, then pretty much the model you would have of the economy could be that there's this big iron machine making Chevettes. And that if output goes up, it's because we're making a whole lot more Chevettes this year. But I think that in today's world, we have iPads. We didn't have iPads before. The guy who invented the iPad is making lots of money, and the countries that are smart enough to align their taxes to take advantage of that cool idea reap some of the rents that the company has too. I think that that's the kind of story that would be consistent with the size of the effects that we and other scholars, including people at Oxford, the University of Michigan, have been seeing in the data.
Great. Thank you, Doctor. Senator Coates?
Thank you, Mr. Chairman. Thanks to both